Hello, everyone. This is Bob Lowe, CSIA Executive Director. Thank you for attending the February CSIA webinar. Today's webinar will provide information for our U.S.-based members on taking advantage of R&D tax credits. Be sure to ask your questions in the Q&A box. The host and sponsor of our monthly webinars is Software Toolbox, a CSIA partner member. Software Toolbox helps system integrators lower their risk on projects that involve software by providing them a unique mix of off-the-shelf software products and rapid response technical support that minimizes the need for custom code and lowers field startup time risk. I would like to introduce today's webinar presenter, Brian Lefevre, Vice President of Operations at Titan Armor in Centennial, Colorado. Brian is a licensed professional engineer in the state of California with a degree earned at Lehigh University. Over the past 5 years, Brian has spent thousands of hours educating U.S. companies on these incentives and coaching manufacturers how to cheaply, efficiently, and adequately document R&D activities and understanding what he calls the end game. Dawson Furcho, National Director Education and Awareness for Titan Armor, will play a contributing role today. So, without further delay, here are Brian and Dawson.
Good morning, everybody.
And Bob and Monica,
Sorry, Dawson, go ahead.
I was just going to thank Bob and Monica for this. Thanks for everybody on the phone participating or spending roughly 60 minutes of your Tuesday morning with us. So we certainly appreciate it. Monica, I don't on my side see the presentation up. Is there something I need to do to get that up and launched?
If you click on that little tab there, you should see it. Bob, you see the presentation, right?
I do. There's a tab, Dawson, just under the menu options.
Under the menu options.
In your browser.
Let me see here. For some reason, I do not see it. I apologize, everybody. All I'm seeing right now, Monica.
Monica, where would he find that tab?
He should see it more like you have a quick start, event information. I don't know if you have that. It's the
there it is. I got it.
And then the next one.
I got it. Okay, very good. I do see it.
Okay, great.
So Brian, go ahead. I think what I would like to how I'd like to have you start before we jump too much into it. One of the things that, in my years of experience, 10 years of experience in R&D tax credit, when folks, small, mid-sized business owners first hear about the R&D tax credit, the name of these incentives has not changed for close to 3 decades. It's called the Federal Research and Development Tax Credit. And so in my experience, what I've found in most business owners is their first gut reaction is that they're not doing any R&D. They don't qualify for R&D. So I'd really like you to break down, what is R&D? And one of the other questions that comes up is, why are these incentives so important, so strategic to U.S. business owners competing in the global economy? So as you jump into the first slide, if you could kind of address it, that'd be great.
Absolutely. So good morning, everybody. This is Brian Lefevre, and what Dawson's talking about is something that we've seen. We spend a tremendous amount of time educating small, mid-sized companies. The big companies have been taking the credit for years. And the reason that there is a misunderstanding of how this credit applies is that when it was put in place in 1981, it was only for companies that were developing patent-worthy, new-to-the-world ideas. And that was the definition of R&D, and that's the definition everybody grew up with. And for 20 years, that's all it was. But it was actually the terrorist attacks of 9/11 and the economic recovery package that Congress put in place in December of 2001, where they had the opportunity to change the definition of what qualifies for this credit. Today, you no longer have to be developing something that's new to the world. You have to be developing something that's new to you, the taxpayer. And so ultimately, this credit, ideally, they could have, when they made the change in the definition, they could have changed the name of this credit from the Research and Development Tax Credit to the Innovation Tax Credit. because that's what this is all about. We are talking about international competition for technology, for manufacturing, for engineering, development on the software side. And as you can see on the tab on the left-hand side, the third bullet down, today we are the 27th country in the world providing these incentives. Congress is clear on this. We are competing internationally. There are 26 other countries that are targeting U.S. companies to incentivize them to move their engineering, their technology, their manufacturing off of our shores and onto theirs. So this is a battle that, from a policy perspective, we're talking about helping companies that are innovating offset their cost of that innovation, because no matter how you define innovation, there's risk associated. Now, most manufacturers will innovate as a means to survive, because if you're not innovating, you will ultimately be beat out in industry. The rest of the industry is moving forward. So we know that if you are successful and you're a U.S.-based company with the high cost of U.S. labor compared to other countries, then we know that your cost of innovating is higher than most other parts of the world. And since Congress is clear on this and want to protect those jobs, this incentive is put in place, and these changes happening in 2001 were put in place to help U.S. companies, small and mid-sized companies, as well as the large companies, take advantage of this incentive program to offset some of those costs so that you guys can compete at a fair advantage compared to other parts of the world and your own competition here in the U.S. There's a quick overview, and I don't know, Dawson, if I hit that on the head, if you have other questions on that. I do want to talk, there was a question at the beginning in the chat box already. The question is, how does this R&D credit apply to S-Corps or pass-through entities, even LLCs or partnerships? The credit is captured at the corporate level. So for an S-Corp, the R&D tax credit is captured as part of the P&L, looking at the P&L and identifying qualified expenses in the P&L and running them through the calculation. The calculation is included on a form 6765, and that's part of the S-Corp return. Now, obviously, the S-Corp doesn't pay any tax, so this tax credit is passed through to the shareholders on the K-1. So certainly S-Corps and any pass-through entity has the benefit of this R&D tax credit passing through to the taxpayers, which are the shareholders. So there's a quick overview of the history of the credit. We're talking about the second generation of the credit is the change in the definition of what qualifies. And that was the first time that small, mid-sized companies, and arguably the folks on the phone here involved in this association and this industry, you probably wouldn't have had opportunity to capture this credit prior to those changes, unless you were developing something that no one else in the industry was doing yet. But today, if you are developing anything new to you, new functionality, new capabilities, new products, new processes we'll jump into here in a second, then the cost you're spending on that development is qualified research expense if you pass the definition. That's part of what we're going to go through here today, is defining what does qualify and why it qualifies. What is it that Congress is looking to help offset the cost for? Now, there is a third generation where we live today, and that is in 2008, the IRS published for the first time in the history of the credit some relatively clear guidance on the level of documentation that's expected of a taxpayer who's claiming this credit. And to keep it real simple, as we train folks around the country, we're really talking about, if you look at say a mileage deduction, you need to keep track of the trips that you went on throughout the year. You need to keep track of why you went on them and how far you traveled, if you expect to capture and successfully claim a mileage deduction. These R&D credits are significantly more valuable. So obviously the IRS wants to make sure that if you're claiming a credit, you're doing it correctly on the right activities, and you're quantifying your costs associated with those activities correctly under the regulations. So on the right-hand side there, you see the definition of R&D right out of the statute is the development of a new or improved business component. And we're going to go through this real quick together on this call. A business component for you guys is simply a project, whatever you guys call a project. Business component is just a fancy term that policymakers put in place. We'll talk about the 6 types of business components in a minute. But if you pass what's called the 4-part test on any project, and there they are listed, and we'll touch each of those, then it's qualified research by statute, which means the costs associated with those projects are qualified research expenses. Now, you guys are currently paying those expenses, paying the full price of those expenses to develop these projects. This R&D credit is an opportunity to offset some of that cost. So do you want to roll to the next slide, Dawson? Yes, sir.
Yeah, Brian, I do have one question I would ask you to unpack a little bit. If you look at the 4-part test, why has Congress focused on these 4 parts as the redefining, if you will, of R&D? I mean, why is technical uncertainty, technological in nature so important? Why these 4 tests, and why not additional tests? What's the importance of that?
Yeah, terrific.
I guess
yeah, go ahead.
No, I think you know where I'm going with that.
Yeah, this 4-part test, this definition has been around since the beginning, since 1981, and it's really a policymaker's approach to zero in and target on the types of jobs and the types of capabilities that we want to defend. And if you look at how technological advances have evolved here in the U.S., all R&D in the U.S. prior to this R&D credit, well, I shouldn't say all, but the lion's share of it was funded through the Cold War era under defense contract spending. So cell phones today, GPS technology, a lot of medical advances were all funded as part of the Cold War efforts under defense contract spending. When the Cold War ended, the defense contracts and the need for that and the funding from federal government dried up. And so we saw as a country, very quickly we started slipping internationally as a technologically advanced country. We were not maintaining that pace of technological advancement. So when this credit was put in place in 1981, it was an opportunity for Congress to shift those dollars from defense contract support to technological advances in industry and commerce. So these 4 tests, as we go through them, you'll see that they're really designed to identify specific activities and ultimately specific types of capabilities wrapped around that word technology, as you can see 2 of them. Really the engineering and the science that we have as a country we want to continue not only to maintain, but to continue to advance.
Great, thank you.
Mm-hmm. All right, folks, let's jump right in. There's 4 tests. So when you talk about the definition of qualified research, the development of a new or improved business component, if you look at the regulations, they talk about 6 types of business components, and you see the term BC business component everywhere. They actually call out 6 types of business components that they conceive when they put these regs in place. The first one, and by far the biggest one, is product development. We hear a lot from, say, job shops that bid work all the time that they're not developing new products. But products is only one piece of the big puzzle. So certainly any products you guys are developing, anything that you're making and selling that's new or improved compared to what you used to have, and again, that's the key driver, what you used to have, not what the industry has. You have every opportunity to compete in an already mature marketplace. Congress sees that as valuable. If you're going to step into a mature market, the only reason you would put the money at risk to jump in and compete is if you felt you had some type of competitive advantage. So product development, new or improved products is a big component of R&D, but not the only one. Process improvements. Certainly in your industry, process improvements is a big part of R&D. And that's developing processes, developing capabilities. Certainly from a pure manufacturing standpoint, it's bringing on new equipment and new capabilities so that you can make your products more cost effectively. And keep in mind, congressional intent is to offset the cost of innovating. You guys are innovating, driving down your cost to compete. You're doing it to survive, because if you don't do it, ultimately you will be priced out of the market. You guys certainly are not running your business the way you ran it 10 years ago or 20 years ago. So that's process improvements. Software is a business component really focused on code writing. There's a lot of going on here, right? See business with the right, any kind of code level development. Buying software, plugging it in, and learning how to use it. The development of that software, the software company that built it, that you bought it from, they did the development and they get the R&D credit for that development. But from a code writing perspective, you could be writing code to sell if you were a software company. Certainly you could be writing code to build into your equipment, which is a lot of what your industry does. You can also be writing code to streamline your own internal processes. They call internal use software. All of that is designed to drive down cost to operate. So that's software. Techniques is it's an overarching umbrella of really how you run your business. Where processes are how you make your products, techniques would be how you execute those processes. And it's very wide what we see as claimed for a technique business component. Certainly on the pure manufacturing side, if you're designing tooling for your equipment for building a part, you're designing fixturing, you're a mold builder, for instance, these guys are all doing qualified technique development. But also things like lean manufacturing initiatives or quality initiatives, waste reduction efforts, green initiatives even can qualify for R&D. And that's the technique business component. So you really want to look at operationally what you're doing to drive out waste. Again, to continue to compete, drive down your ultimate cost of sale that you can maintain a competitive advantage. Now, formulas might not be a big play for your industry. It would either be developing new raw materials, new recipes, in the food and beverage industry, for example, but potentially a good component of formulas for most manufacturers is attempting to use alternative materials, changing suppliers, changing vendors for raw material for cost, provides a built-in risk, an inherent risk operationally because those materials work differently. So you might have to modify your tooling, you have to modify the way you make your products. That could be a formula business component. The last one's inventions. That's the old R&D credit, still there. It's the patent-worthy, new-to-the-world stuff. There is, if you develop a patent and win a patent, it is regarded as an invention. You don't have to step through as much of the qualifying process if you've won an invention. But for most of our clients, even if you are developing patents, you're spending the money on that advancement, on that innovation, well before you win the patent. So from a day-by-day perspective or a year-by-year perspective, we're looking at the costs. And again, I didn't touch on that on the first slide, but your costs associated with R&D, by far the lion's share cost is your labor cost. So for those of you that are innovating, some amount, if you look at how much you spent in raw labor over a year on your tax return, some percentage of that labor is qualified research expense, qualified research labor. And by far, statistically, that's 80 to 85% of the qualified expenses across the country of everybody claiming credits. But there are two other components of cost real quick. One is supplies. That's raw materials consumed in the development of these innovative activities. And the third one is contractor costs. If you are outsourcing a service, a support function for developing these activities, it doesn't have to be done in-house. The 1099 cost of that subcontractor is a qualified contractor cost. So anywhere in these 6 business component types, these are the areas that Congress has called out, the areas of your business that could potentially qualify for R&D. Now the term new or improved in the title, the first test here, new or improved business component, is statutorily defined as the permitted purpose, or you'll also see in the regulations the qualified purpose. And they actually call out 4 types or 4 permitted purposes. And it says in the regulations that the taxpayer needs to be attempting, and that's an important word, we have it highlighted on the right-hand side, attempting to develop new or improved functionality, performance, reliability, or quality. Quality obviously being a big part of continuing to compete and is called out specifically. So if you're developing a product, or for you guys, if you're developing a process, and it's a process compared to your previous designs, if you're developing something that's new or improved in that project that you didn't have before, then you've passed the first test. Now, how do you define new or improved? Well, I can tell you from all the audit work I do and the work I do with the IRS, there's nobody better to present what that permitted purpose is than the project manager, the guy responsible for that project to get to the end of that project. This is what we call the why question. Why are you guys spending the money at risk? I see a question. Can a process be an improvement of a business process? It can, absolutely. You will see that would certainly pass the first test, but let's look at the next 3 tests to see if that business process you're considering passes the other tests. So certainly a business process improvement is a potential R&D project. So if you want to move on, Dawson, to the second test. The second test is called the Technical Uncertainty Test. It's referenced in IRC Section 174. You can see the quote right out of the statute on the left there. It says the taxpayer needs to be endeavoring to discover information that you didn't have at the outset of the project. This is the uncertainty, the unknown, the risk that you guys are spending money on. And you're taking that risk and spending those dollars to move the company forward. Now the regulations do call out 3 types of technical uncertainty, and they're reiterated again in some of the case law. The first one is uncertainty in your capability to develop that business component. Certainly if you're looking at something new that you've never done before, there might be some risk or uncertainty of whether or not you can actually produce it, or I should say more importantly, produce it cost effectively enough to compete. The second technical uncertainty area is uncertainty in your research method. Really more historically designed around, think about a laboratory or a chemistry environment. The research method, the scientific method, how are we going to get from the original concept to the final design? For most taxpayers that we work with, the research method's pretty standard for you. You have a systematic way of running your business, going from original concept to final design. So there's probably not a lot of uncertainty in your method. But the last one, the appropriate and final design, that is by far the largest component of technical uncertainty. We like to joke with the operations guys, the engineers and the plant guys, that if there was no technical uncertainty in the concept of this business component, well then let the sales guys or let management or admin folks do that development. And if that does not make any sense because they would not be able to develop an appropriate or final design, you've identified your technical uncertainty. We streamline that when we present defensibility of the project. We call it the how can we question. It's the question your team asks each other about what is it about this concept or this project that you don't know that you have to evolve and get to a final answer. So ultimately there has to be risk. This credits to offset the cost or the risk associated with moving your company forward. And by moving forward, we're talking about, back on the first test, the new or improved component of your work. Next test. The third test is called the Technological in Nature test. And for those of you that like reading statute, you'll learn that this is actually the second test. But we made it third because it's easier for guys that we work with, the project managers, to identify the purpose of the project, that's the qualified purpose, what you're trying to do, and then identify the risk or the uncertainty. And the third test is, if you look at the regulations, the taxpayer needs to be fundamentally relying on the principles of either engineering, physical science, biological science, or computer science in an effort to resolve that uncertainty. And back on Dawson's question a few minutes ago, this, folks, is what Congress is trying to protect. We're trying to protect our engineering and our science capabilities, not just in development of products or in development of capabilities, but also in the development of a manufacturing process. We want to continue to compete on the manufacturing front as well. But down below there, we talk about relying. The word relying is very important. Congressionally designed to say that you don't have to be a degreed engineer to be relying on the principles of engineering. The favorite guys I work with, they're around R&D in the country, are the plant guys, the maintenance department, the tool room. These guys are mechanically oriented. They are relying on the principles of mechanical engineering to get the most out of that equipment, regardless of whether or not they have a degree in that mechanical engineering in that example. On the right-hand side, there's some examples of different disciplines of engineering science that we see in R&D. The one I like to call out is physical science. Under physical science, mechanics of materials, developing new products, new products. That design is controlled by the mechanical properties of the raw materials you guys choose. It's a very, very important part of R&D today, not just here in the U.S., but internationally. Certainly for you guys in your industry, mechanical engineering, electrical engineering, industrial engineering for certain, definitely on the computer side, developing code. You guys are writing code to run your equipment. You're using a specific platform and a specific coding language. You are relying on the principles of computer science to develop that business component. So back on the question about, sure.
I was going to have you unpack a little bit. You know, we talk about this relying on the principles of, and as the participants on the call think about their labor wage expense, so, you know, being the biggest bucket that drives the credit. Certainly those folks that do have degreed degreed folks, but also people that rely on the mechanics of materials, et cetera, are going to qualify. But what about the rest of the organization? Are there cases where technical sales folks, admin, direct supervision, IT folks that would be relying on or driving potential qualified research expenditures?
You bet. So you're really touching on a couple of things. There are folks, and there are examples in the regulations that call out, for instance, the support folks that, and this is actually an example in the regulations, so the support folks that wash the laboratory equipment after the experiment. That is a qualified expense. That labor cost is a qualified expense. It is direct support of qualified research. Direct support and direct supervision of a qualified activity are qualified expenses. We do have a limit and that is that 80% of the effort on the project has to be the qualified effort. Up to 20% can be the support and supervision. But it's clear that even a laboratory scientist doesn't do their work in a vacuum by themselves. There's support and supervision associated with that work. So absolutely, those folks would qualify. There's another example of administrative support of an engineering department that is running running copies of drawings or prints for the engineers, direct support. So certainly there are areas around, I think, Dawson, you touched on sales folks. Sales folks, I can tell you, typically a salesperson is probably, if I was to guess, 5 to 15% of their time involved in the preliminary concept development of a new product or a new process idea. So to the extent that they are, is really related to how technically oriented they are. Some sales guys are very technically oriented. They may have come from an engineering background and got into sales. And some sales folks are more rapport building, relationship oriented, not as technically oriented. It's the technical component that we're interested in. So the question came up about the business process. How can the business process be technological in nature? Well, that is fundamentally the question that you have to address for claiming that business process as an R&D project. So for instance, you want to improve a business process. We want to look at, let's take an example. If your business process improvement is wrapped around changing your standard procedures, that will not be R&D, because that is considered social science or behavioral science, not hard science. But if improving that business process includes maybe writing some code to streamline communications internally between departments, then that would be the stuff you'd be interested in. So it really comes down to this technical component. So business processes relying on computer science would certainly be an example. Is there a business process that relies on mechanical engineering? Yeah, possibly. But again, there's nobody better to answer that question than the guys doing the work. On to the fourth test. The fourth test is called the process of experimentation, and it says the taxpayer needs to evaluate one or more alternatives in the effort to resolve that uncertainty. The word one I want to call out is very important, dates back to the beginning of the R&D credit. Congress made it clear that if you get it right the first time, you evaluate one alternative, you still pass. Obviously, we don't want to be penalized for being good at what we do. Now, in all the R&D work we do on the ground, working with engineering folks, scientists, plant guys, I can tell you that there's really 3 main fact patterns for process of experimentation. So apply this to how you guys do your work. And it really comes down to that method. When you think back of the technical uncertainty, the 3 types of technical uncertainty, one is the research method. The first method, and the one that's obvious, is in the laboratory sense, the scientific method. Developing a hypothesis, establishing a control, changing a variable, and measuring the result. Going back, modifying the hypothesis, and going through that process again. What's great about the laboratory folks is the scientific method is documented already. So their process of experimentation has a paper trail. But for the rest of us, that's not necessarily the case. The second fact pattern we see often in the engineering departments is what we call evolve the design. That's that systematic way of going from concept to final design. Engineering departments that develop products or develop processes, they go through a systematic way. And generally that method or that approach is pretty standard for your company as a culture. And the third one, the one I love the most, is really what we see in the plant. They don't have a formal methodology. They generally use trial and error as their method. So if the business owner comes to the foreman and says, look, you're getting 50 parts an hour out of that piece of equipment. I need 60. Well, I need 60 because we need to continue to compete, and the industry is driving down costs. We have to keep looking to ways to drive down cost. So the foreman and his help, is the plant manager or maybe even the operators, they're involved. They scratch their heads. They try one thing. That doesn't work. They try another. And they'll keep trying until they're successful, or, which we didn't talk about earlier, even if they fail. Remember back in the beginning, this is about attempting to develop something new or improved. It is completely unrelated to whether or not you're successful. It has everything to do with your costs associated with that attempt. So those are the 3 processes of experimentation we see, and it's important to be able to show an evolution of your attempt to resolve that uncertainty. And that is the fourth and final test of the 4-part test. And so back to Dawson's question about why these 4. Well, we're not the only country, of course, in the world providing these incentives. In other countries, call them Australia or Canada, they have very similar definitions. So the definition of qualified research internationally is pretty well established. And again, focusing on the 3rd test, it's really all about the engineering and science. You have to be trying to move yourself forward, right, developing something new or improved. There has to be risk. You have to be using engineering or science to resolve that risk. And you have to show that you go through an evolution process. So that's the 4 tests. And now if you go to the next slide, Dawson, this is how we train folks. We train operations guys and plant guys and engineers. We don't try to make tax experts out of them. That's what the CPAs do. You can see the 4-part test again reprinted on the left. We train on what we call the quick test. I mean, I can ask any plant guy or a shop guy or an engineer, today, if you look back on your day, did you do anything today that was what we call neck up work, right, using your head? That would be thinking, designing, problem solving, resolving uncertainty, evaluating, testing. That's all neck up work. Neck down work would be things like production, maintenance, customer service, management, sales, admin. That's all status quo stuff. It's important for the company, but ultimately the neck up stuff is what the R&D credit's about. And you have to be using your head in an effort to make something better. And that's moving the company forward in your products or your processes, software, techniques, formulas, or inventions. Now, of course, the quick test does assume that somewhere in there is an engineering or scientific component. But if I go to any engineering department or any plant floor production department, I can generally find an engineering or scientific component. If we work with software development guys, coders, they're developing code, they're conceiving called the detailed requirements or the architecture. They're writing code, they're testing that code, they're going through a process to get that code to do a certain task. And that's a great example of how the quick test is a way for you guys in whatever role you're in, whether you're in management or your engineers or your plant folks. It's very easy for them to start breaking out what they do every day that's qualifiable by the definition compared to the stuff that's not, the neck down stuff. And I think I have one more. That might be it. Oh, here's a quick way to estimate your benefit. Again, we talked about on the right-hand side real quick, you're looking to quantify your qualified research expenses, QREs. And there's the three QRE types, labor, supplies, contract, as we talked about. On the left-hand side, to estimate, just to figure out what this credit's worth to you, look at your list of employees. And if you apply the quick test very quickly based on what you know that employee does for the company, you can apply a quick percentage to each one of those employees. So for instance, if the first one there, an engineer, if 60% of that engineer's time is spent doing neck-up work trying to make something better, 60% is what the IRS calls his allocation percentage. Down below, you see the calculation for that employee's contribution is their allocation percentage times their W-2 wage. So you are paying that engineer X number of dollars to work for a full year. Some percentage of that W-2 wage is considered qualified research expense. So the contribution, if you calculate the contribution for each employee, we have 4 examples up top. You calculate that, you come up with a total QRE labor amount. So in this case, $600,000 of your total labor cost is qualified research labor. And back on the right, you do have to look at, well, you don't have to, but you are allowed to look at supply costs, which is raw materials consumed in the development of qualified research, and any third-party contractor costs. You add all those costs up, that's your total QREs. Now, this is a very, very simplified approach to estimating your benefit. The calculation is a little more complicated, but just to get you in the right ballpark, this is a pretty fair way to do it. So if you add up your QREs, in this case we have $750,000 in QREs in the top right, your federal credit would be roughly 7% of that $750,000. The benefit is a tax-affecting benefit. That $750,000 calculates out to a, what is that, roughly a $50,000 credit? Doing the math in my head. Whatever that credit calculation is, you have to add that back to your expenses. You can't use those dollars as both a credit and an expense. So there is a tax-affecting component that goes on. So your net benefit after all that, and that gets run through on the tax return, your net benefit here is $45,000. Obviously, you're paying that $750,000 in expenses already. Congress stands on the side and says, look, we want to offset some of that cost. And in this example, they're going to reduce the tax bill by $45,000.
Hey, Brian, Randy's got a question that maybe you can address, and then I've got another question as it relates to kind of understanding the end game, you know, what's incumbent upon the taxpayer, because we've talked a lot about documentation. But Randy had a question, does this apply to R&D projects we are doing for customers?
It can, and it's going to come down to the contract language and your relationship with your customer. And it has to do with this concept in the regulations called funded research. To keep it real simple, there's 2 components you have to look at. One, who owns the risk? And the risk is, for instance, if you're doing time and materials and you're getting a markup on your time and materials, your customer has the risk, and therefore you are a contract research expense to them. So in the blue area here, that contract cost dollars, that $100,000, your invoice to your customer, they should be grabbing that invoice as part of their R&D credit because they own the risk. The second component to this concept of funded research ultimately is who owns the intellectual property, the IP. So for those of you in the industry that are developing custom projects for specific customers, they come to you with a custom need. They have constraints and requirements. You have to develop a system or a process to meet those requirements. If you have to develop something for them that you can reuse for another customer, then you own the IP. If your contract language with that customer says that whatever you develop, you cannot reuse, in other words, they own it, then it's their IP. So those are, in simple terms, those are the two hurdles you have to get over on this issue called funded research. So you look project by project. Some projects very well could be completely funded and not part of the R&D credit. And others would have a component of qualified labor supply contractor costs associated with that project.
Okay, thanks. And through a number of these slides, you talk about documentation, and as you consider participants on the phone, whether they're looking at first and foremost taking advantage of these credits, having not taken advantage of them before, or they are currently self-assessing or using a specialty firm for taking advantage of these incentives. What, as the regulations call out, what's incumbent upon the taxpayer as it relates to documentation, Brian? In specifically, if the IRS were to review claims for qualifying research activities, what are they going to focus on? Are there two, we talk about quantitative or qualitative, if you can just kind of unpack that a little bit as to what the IRS will look for.
You bet, but let me touch on, it looks like there's a couple of questions that came in on this funded research. And the question I see a few folks have asked is, what about T&M with a not-to-exceed cap? Ultimately, if you look at the way the regs are written and the way that contract is written, if you're bidding that with a cap on it and you want to win the work, you have to figure out how to bring that project in cost effectively. So generally, and again, you have to overcome these hurdles, and it's going to be facts and circumstances related to the contract language. But any kind of contract with a cap on it, it's clear that you're bidding against somebody else, and whatever number you come in at and whatever number you put a not to exceed amount on, you're adding more risk to yourself. So from a congressional standpoint, they see that as very, very valuable and something we want to promote. You're going to win the work if you'll take on more risk than your competitor, or more importantly, you're smarter. You're using your head more to drive that risk down. Ultimately, it's about competition, and so generally a T&M with a not to exceed cap on is going to meet the risk requirement component of the funded research. There was a question, if you take the risk but client takes the underrun, again, you have risk. If you have a cap, then your job is to come in under that cap. And for those of you in the projects that you've bid on and you bid with a cap and you make a mistake and you blow past that cap and you lose money, obviously you don't want to do that very often, or you won't be surviving. So again, we're looking at who owns the contractual risk. Even if the client takes the underrun, the risk is your job is to get your engineering department and your folks to use their head to build something better, faster, cheaper than the competition, whether that competition is down the street or across the ocean. So shifting back to your question, Dawson, about documentation. And this is ultimately why, folks, we as engineers and a software company got involved in the R&D credit in the first place. When the IRS changed the definition or changed the expectation for substantiation back in 2008, what they are looking for, and this is a great slide to look at, what they're looking for is two things. Dawson touched on what's called the quantitative and the qualitative assessment. Quantitatively, you need to be able to prove that that engineer, for this example in the top left corner, that engineer spent 60% of his time on the job doing qualified research. Well, how do you do that? Well, ultimately, the best way to do it is to have that engineer track time. If he worked 2,080 hours and was that 1,260 hours was qualified time going to qualified projects, well, then that 60% is bulletproof. It's locked down. If you think about that quantitative assessment, much like we talked about at the beginning, a mileage deduction. You can estimate for sure how many miles you drove at the end of the year for the company and take your deduction. In audit, if you don't have a documentation trail, a contemporaneous documentation trail of where you went, why you went there, then you're going to struggle in defending that deduction. Very similar to the allocation percentage. There are a lot of consultants out there that come in after the fact, interview employees, and then estimate based on that interview what percentage is fair and reasonable. The IRS put heavy scrutiny on that approach back in 2008 with the assumption that was later proved that from an estimating perspective, a consultant is going to generally estimate higher than what's appropriate, because generally they are compensated based on the credit that they find. So documenting that allocation percentage is a key component. For those of you that have, say, an ERP system and tracking time, that's a huge step in the right direction. For those of you that don't, one of the reason we're in business or as a software company in R&D is we built a very, very easy to use platform, web-based platform called Titan Armor. And it does the two things that the IRS is looking for. One, it does make it easy for your engineers and your plant guys to document that stuff. And the other one, let's talk about the quality of assessment. An auditor, just like a mileage log, an auditor wants to know which projects you're claiming as R&D. And the regulations call out that the taxpayer is required to evaluate every project that you're considering as qualified research under the 4-part test. So the goal is to make it very efficient and build that paper trail like a mileage deduction. Do it as you go throughout the year so that you have a substantiation paper trail for how your calculation was put together. And that's a simple way of saying what the IRS is looking for in the audit, those two things, one, quantitative, and two, qualitative. Are your projects qualified research under the 4-part test? Now, it's an opportunity for me to also bring up, which is beyond the scope of this call, that even if you answer the 4-part test well, there are activities in the regulations called statutory exclusions. These are political issues that Congress, throughout time and continues to evolve, activities that are statutorily excluded regardless of whether or not you pass the 4-part test. The one that's easy for everyone to understand is called the exclusion for foreign research. If you're doing R&D work, but you're doing it in China or Canada or Mexico, it is going to be excluded. You cannot get a credit for those activities. We're looking to protect the jobs here on our soil, and so the exclusion for foreign research is a great example that even if you pass the 4 tests, it's simply not going to qualify. And ultimately, that's what we rely on the CPA to stay current with those changes. We're on the audit front as a company, and we keep all of our CPAs current with what we see in those audits. So it's really the CPA's responsibility to make sure that your documentation, your substantiation meets those expectations.
Hey, Brian, Cliff had a good question, kind of going back to the S-Corp discussion. How does the credit affect a non-contributing shareholder, i.e. passive shareholder?
Yeah, very simple. Yeah, I think it's in IRC section, I want to say code section 58, but don't quote me on that. And it says that the passive shareholders capture the credit, but they have to amortize it over 10 years. So if you're capturing a credit every year, the first year you get 1/10 of your credit, the second year you get 1/10 of this year's credit and 1/10 of the previous year's credit. So there's an amortization requirement for the passive shareholders.
Good.
Now, this is just a little plug on time tracking. You don't need, let's talk about, again, the allocation percentage time tracking. Everybody sees that as a massive burden. It's not as complicated as it sounds. Ultimately, 1-hour increments over a day are more than accurate enough. What's important about those hour increments, so let's say an engineer works 9 hours. It would behoove him to track what he spent those 9 hours on. And if he estimates those every day, if he put 3 hours on one project, 2 hours on another, and the other 4 hours are administrative, non-qualified stuff, that would build a great paper trail. However, I do want to talk about the ERP platforms that we see. The process of experimentation test, the 4th test, is challenging for most ERP systems. So if you are tracking time already, that's excellent. Where you want to focus is that time tracked at, say, just a project number? In other words, if you have lumped all of your labor costs into a project code number, that does not quite get you where you need to be on the process of experimentation tests. And again, we did touch on what's called substantially all. 80% of the costs associated with that project have to be qualified costs. So there is really 3 levels deep of information that you would want to track to really meet all the requirements. So if you have an ERP system and you're tracking costs just at the project level, consider breaking that project into subcategories. The IRS calls those subcomponents. So that if the engineer spent 3 hours on that project, what component of that project did he work on? Did he work on the, we use for generic examples, was he working on developing the specification? Was he working on the design part? Were we working on developing the prototype or testing the prototype or developing the, for lack of a better term, the pre-production effort to streamline the operation into mass production? So there's components of that project that we want to be able to show so that we can show a process of experimentation. And then again, within each of those subcomponents, we want to be able to tell if he spent 3 hours today on that subcomponent, what did he do today? Was it a qualified effort that he worked on today, or was it a support or supervisory effort? And that's addressing that 80% substantially all. So we've trained folks to get in and out of a time card effort at the end of their day in 1 minute. It shouldn't be any more effort than that. That level of documentation done very, very quickly at the end of each day gives you the paper trail that supports the claim. And also keep in mind, we don't need all the employees. We need the key employees. The supervisory support folks, the folks that might touch R&D a little bit, but not worthy of them spending a lot of effort documenting their effort throughout the year. Estimating their allocation percentage is significantly easier if you have a good, solid core of documentation from your main contributors of R&D effort. So don't look at this requirement as a massive burden. It doesn't need to be. And that's what we have done for 4 or 5 years now, trying to help manufacturers and taxpayers capture the credit that they deserve and do it very, very efficiently and defensively.
Hey, Brian, just a couple quick questions. When we think about the longevity of this credit, it's been around for 30 years. The question I would like you to address is, number one, is it a permanent credit? Obviously, it's an incremental or annual credit. Is it permanent? And what are the years open for these credit incentives?
Okay, great. Yeah, they put the tax credit in place in 1981, and the first go-round, I think it was, it had a sunset on it. In other words, it expired 2 years later. And ever since then, it has needed to be extended. And we just went through that extension process this last go-round with these fiscal cliff negotiations at the end of 2012. So it is a temporary tax credit, and since its inception in 1981, we've only missed a 6-month period of all that time. So although there is uncertainty and some unknown about what the future holds, there is no uncertainty in Congress's mind about the international competition and the need to protect our technology. We would like to see, even in the negotiations that are happening right now on Capitol Hill, with some revamping of the tax code, we might see this credit become a permanent tax credit in the regs. That would be wonderful, especially for companies that have multi-year R&D credit objectives. That uncertainty produces a pretty significant risk for them. So that's the forward-facing look. Backwards, for those of you that have never taken the credit and you run an estimate and you say, wow, there's a significant amount of dollars here that we've never addressed. The law, like every part of the tax law, you have the right as a taxpayer to amend your tax return back only 3 years. So after 3 years back, you can no longer make changes. But you can certainly look back the previous 3 tax years, capture your R&D credit, and amend the tax return, because in essence, in those years, you've overpaid your taxes. So you have an opportunity to recover cash for that overpayment. But I would strongly recommend to do that. You won't have the documentation to support that. Obviously, you didn't know it existed prior to this call, perhaps. You want to get focused on good forward-facing documentation as a means to corroborate and support the estimates in those years.
This is Bob Lowe. I have a question.
Sure.
Most of what our members do are projects for like manufacturers or energy companies or water, wastewater treatment facilities and that sort of thing. So they do design, engineering, programming, and so forth, and each project is typically unique in and of itself. They're one-offs, what we call one-offs. Do they have to own the intellectual property of that project for any of the work for that project to be applicable? Or it's what we encourage our members to do in their terms and conditions, is to make sure that they own the intellectual property upon conclusion of the project, and then they essentially license their client, whether it be a manufacturer or whoever, to use the output of their work. But do they need to own the intellectual property to take any credit for risk-taking in new designs or new, the code being written is custom because they never did a project like this before or whatever? Is the intellectual property here the driving force or the factor that determines whether they get to take any of it or if their client gets to take it?
Yeah, it's an excellent question, and I see there's a question in here similar to that. Certainly, if you are paid to develop intellectual property for a customer and then they want to own that and that's written in the contract, then you would most likely be considered a contract R&D, a contractor for them to develop their R&D. It does get gray when they want to take the IP and they want to hold you accountable to a fixed fee or a cap.
Right.
Yeah, that is common.
Mm-hmm. Well, yeah, intellectual property, it's where good contracts come in, and again, we encourage our members to maintain the IP of what they do. How well they do that is unique to each of our members, I'm sure, but so it comes down to writing a good contract, I take it?
Yes, a component of that, but then you also look at, I'll give you an example, but let me first try to explain. If you develop a component of that project, let's say you have to get one piece of equipment to talk to another piece of equipment, and you have, as a taxpayer, have never done that before, these two specific pieces of equipment, and you build this process, this system, and you sell it to the customer, and they own that system and the IP associated with that system. If you contractually have the right to reuse what you designed and developed, specifically that communication between those two pieces of equipment, if you can use that code again for another customer, then you have developed capabilities for yourself that you don't have to recreate that again next time. So you are advancing your company and your capabilities. So certainly contracts are important, and especially if contracts allude to IP transfer to the customer, you have more, call it more gray area or more uncertainty as to whether or not what you can claim for R&D. Here's a great example. We have a client that designs molds, plastic injection molds, and they work for OEM companies that compete with each other. And one OEM company will come to them and say, we want you to build a mold to make this part. This might be a new part for our, whatever, dashboard for our new model. But it's our part. And the mold that you make is our mold. We're going to buy it from you, and we own it. You can't take this mold and this design to our competition. So in that case, they own the IP, and generally that's a fixed price contract. The mold builder's got to come up with a mold to do that. But in the process of developing that mold, they go through a trial and error process. They go through a process of experimentation. There are features and components of that mold that are difficult to make. From a plastic injection molding perspective, you got to push liquid plastic through a very cold, called an aluminum block, and it starts cooling off as it goes. So it ends up hardening, and so getting the plastic to fill the complete cavity is a trick. And there might be features and functions associated with that design of that part that came from that first OEM that the mold builder never had to do before. And I've seen examples and been in audits where those features, those functions, were very, very difficult for the mold builder, and they had to try different stuff, and they'd test and it didn't work, and they had to try different things. And so they had to keep going through this process. At the end of it all, they sold the mold. Whether they made money on it or lost money on it, they sold the mold, they got the job done. The second OEM comes with a completely different product design, but it has a very similar feature or component associated with it. This mold builder has learned something on the first project and therefore can produce the second project more cost effectively. So in that case, they own the, call it the IP of that feature or function. They're not precluded in their contract. Although they did sell the mold, they can't sell the design of that part or sell that mold to the competitor. But their knowledge, their advancement, their technological capabilities have improved that then benefit industry for the next go-round and makes them more competitive. So when they go to compete on the next mold, they see a crazy feature or function that they've done before, they are already one step ahead. So and they are not precluded, in that case, they're not precluded from taking what they learned on the first project to the second project. And that's what we would call a technique, the how you execute your work. They're not selling the product. They're not reselling that. They're not allowed to do that. Certainly the process in that case would be the plastic injection molding capability, the machine and the way they blow the liquid plastic in. But the technique of how to work these crazy little components, they have special stuff. That stuff they carry on with them. And every year that they stay in business, they get smarter. They get better, they get faster, which ultimately makes them more competitive. And that's what we're talking about.
Okay, that does answer my question. I think most of our members could relate to that. You know, the example you gave of getting one machine to interface to another machine is that's a risk. But what they learn as a result of doing that can be reapplied. But again, I really like to reiterate to the attendees on the call here that they work very hard at maintaining intellectual property to the highest degree they can, so that a lesson they learn on one project can be applied to another, and they're not prohibited from reusing it. That's what we call reuse library. And
right.
The way to do that legally is to maintain the intellectual property and simply give their clients a license to use what it is that the outcome of their project was.
Right. And I've seen contract language where the entire process you guys cannot reuse because your customer wants to hold that. But the components, some of the stuff that you learned in there, if making one piece of equipment talk to another, if you have to do that on the next project and you are not allowed to use what you learned on the first project, which means you have to rebuild the code, obviously you're getting farther and farther away from a defensible argument that first project was qualifiable.
Right. I have another question. We have a CSIA certification program, and it's based on our best practices manual, which is a guide on how to run a really good system integration company. And we've extracted like a subset of that manual, and these are business practices, and it requires having an auditor come to your facility to test you on your business practices, these 79 criteria. Now, preparing for that audit is an arduous task, and it could be anywhere from writing better job descriptions or a better hiring procedure under the HR section of the audit, which is not highly technical. It's just simply writing a procedure. But on the other hand, they may upgrade their ERP system from, say, QuickBooks to what's called Deltek. It's a package on the market that many of our members are going to. And it's a huge task to go from QuickBooks to Deltek, and that enables them to, so this isn't, they're applying a new software package. It's a technology, and enables them to manage their projects better, manage their finances better, and track time better, and so forth. What component of preparing for that CSIA certification audit might apply? You know, again, job descriptions on one end of the spectrum, and applying a new software, ERP-type software, on the other end of the spectrum.
Right. Terrific. So the regulations, actually, we talked about some statutory exclusions, foreign research. There is a statutory exclusion for behavioral science, or what they call soft sciences. And you think about changing the procedures for hiring, writing better job descriptions, that's all procedural. Social science stuff, completely excluded.
Okay.
No chance of getting that stuff. In the case of the ERP system, moving over to we call it Deltek, a new platform, that is not going to be qualified research either, and I'll qualify this, because Deltek designed the coding of that ERP system. Your process as a taxpayer is again training, which is procedural, training folks to use the new system, and migrating data. So that would not be qualified research. Now there's components in there that might. For instance, any custom modules that you want Deltek to build for you as a taxpayer that they don't already have built. The custom coding, whether you pay them to do it or you pay a third-party coder to build it, or you guys have an in-house coder that can write it, that would be custom code. That would be a software business component, the module itself.
Okay.
There is, go ahead.
Let's say they internally write their own database for doing something similar to what Deltek's doing. In other words, they actually develop their own internal software, which is very common amongst our members. Would that be treated differently than implementing an off-the-shelf package like Deltek, which takes configuration but not necessarily code writing?
Right, right. Certainly, if you guys are building your own database, you're moving closer to qualifiability.
Okay.
When you take on that task to build a platform, an internal use software platform, there is a line of regulations called the internal use software requirements. It's called the high threshold of innovation test. So there's 3 questions. Ultimately, it comes down to this, and to keep it simple, let me step back. When it comes to internal use software, it is one of the most heavily debated issues in the regulations today. And the reason is the regulations that exist today were written in the early 90s, really prior to every employee having a computer on their desk. So software, the concept coming from Congress back in that time period was that software development, and specifically internal use software development, was not a big part of innovation. Clearly today it is. I mean, in fact, it could arguably be said that it is the most important component of innovation, because anything that you're doing to write internal use software is all about driving efficiency, driving out labor costs in your operation, improving quality, communication. In all the audits that I do around this internal use software, the auditors all say the same thing. We need Congress to rewrite this section of the law, because we are applying law that is grossly outdated. So when we get to internal use software today, and again, this is a very simplified way of looking at it. You have to be able to show. So I would ask you this simple question: why are you writing it yourself instead of having Deltek bring it in? If the answer is it's cheaper, we have to get over this high threshold of innovation. If you say, well, we're writing it because their system doesn't do some things that we need done, well, then you have a stronger argument. Okay. So I hate to be, as an engineer, I hate being evasive and not black and white, but when it comes to internal use software, well, really all the law around R&D is facts and circumstances on the project. When it comes to internal use software, there's just a degree more of uncertainty and interpretation of the law as it applies to those facts.
Okay, so there'll be more success for our members in regard to technology as it applies to, and innovation as it applies to the work they're doing for their clients in projects, more so than internal improvements.
I don't know that I would say that, Bob. I think all the internal use software your members are developing, they're developing for a specific reason. It's a matter of presenting that project or identifying that project in light of the regulations to show that it's still qualified research. And if Congress could rewrite that section of the code, we wouldn't have this gray area uncertainty. Writing software to sell, like a software development company that develops software and then packages it and sells it, like us, right? That's clear that's R&D. When it comes to internal use software, we just have to step over a couple more hurdles to present it. I would tell you that most of the time, if we can get into the details, we can present an internal use software development project as qualified research.
Okay.
Hey, Bob, there's one last question. I know we're a little bit overrun, but I think Francis got a great question. Brian, I don't know if you see it, but he's requesting you clarify the benefits again. Again, if I claim 100K in R&D expense, I get 7K in tax credits over 10 years, but as an S-Corp with an individual tax rate of 35, aren't I better served just taking the expense?
Great question, and the answer is no. You're not deducting the $100,000 from your expenses. You're only deducting the $7,000. So your taxable income goes up by $7,000. You pay 35% on that, so you're going to pay $2,000, $2,500 in additional tax. But you can use the $7,000 to pay that. So what you have netted in tax credit is the net benefit in our example. You only add back the credit calculated amount, not all of the expenses that went into the credit. And I have a question here, document reusable code/methods. I'm not sure what that question is. Oh, there is a question. On the issue of funded research, do you have to overcome both? The answer, I would say, is yes, and it's actually a little more complicated than just those two hurdles. But those are the two hurdles that are focused on both in the audits and in the court cases. If you can overcome both of them, then you have a strong argument that you are not providing funded research to your customer. Could you still qualify for R&D if only one of those two components was addressed? Generally, I'm going to say no. If you can't, for instance, if you have no risk, regardless of the ownership of the IP, then you are not going to be able to qualify that as R&D. And vice versa, if you absolutely get none of that IP, even though you've taken on some risk, you're not going to be able to overcome that either. But again, I go back to that example. Just because your client takes on the intellectual property rights of the overall process, are there components of that you can reuse? So it's a question of looking at it correctly.
And Brian, it looks like Fred tried to get clarification. So document reusable code/methods to show ownership.
Yeah, it's a great way to do it. Great way to do it. So if you're trying to if you're developing code to make one piece of equipment talk to another, and then the next job comes and you don't have a code library to pull from and you have to start from scratch, you're going to be hard pressed to say that you own the IP of that first project. If you have a code library that you can reuse at your discretion, certainly you're making strong arguments that you own that IP.
Well, management of a reuse library is one of the components of our best practices and audits. So there, this the R&D tax credit certainly would drive people to do two things that I see now, and that is really work hard at maintaining IP and maintaining a quality reuse library.
Yeah, both of them are valuable, right, to continue to compete. We don't want to have to keep doing the same thing over and over again, especially when we know our competition is learning from what they've done in the past. We've got to do that in order to survive.
Well, gentlemen, do you have anything more to offer? I don't see any other questions to answer. Is there anything you want to close with before I close?
Yeah, I think when I sum up, I talk to business owners. You really have a couple of options here when as it relates to the R&D credit. The first one is you don't have to take the credit. Certainly, you can overpay your taxes. You can pay more for your innovation than your competition is. That's the first one. The second one is, like the mileage deduction, you can guess. You can estimate, like we showed you, to get a tax credit and get the numbers on the tax form. And that's more of what the industry calls a audit lottery approach. And the third one is know what's expected. It's called Know the End Game. It's another presentation we have really more for CPAs to understand what that audit environment looks like, what the IRS is expecting to see in an audit. And if you understand that, we can show you very efficiently that it's not a huge administrative burden to meet those requirements. So those are your three options. Don't take it, guess at it, or build it correctly and take it with confidence. So we want to continue to promote the protection of U.S. engineering and technology. We're very, very passionate about really the patriotic side of what this R&D credit means about protecting American companies and American families. So we want to strongly recommend that if you guys haven't taken the credit, to talk to your CPA about it. And certainly if you have any questions, we're always available to continue to educate and train and support.
Okay. I don't see any other questions that have come in. So with that, I'd like to bring today's webinar to a close. So to all of the attendees who have stayed on here well past the hour, we thank you very much for your participation. And my hope is that you have several takeaways on how you can easily take advantage of this tax credit. And Brian and Dawson, thank you very much for your contribution of time and expertise. And your presentation was very insightful, and we wish you and Titan Armor the best. Thank you again to our host and sponsor, Software Toolbox. Monica, you've done well today. Be sure to complete, this is to our attendees, be sure to complete the survey for today's webinar. It'll arrive in your inbox within an hour, and it really only takes 30 seconds or a minute to complete, and your feedback is really necessary for our continuous improvement. So in closing, here's a kind of a CSIA bullet list for you. Attend the 2013 CSIA Executive Conference in St. Petersburg, Florida. The registration link can be found on CSIA Connected Community or controlsys.org. Second, if you haven't renewed your company's dues for 2013, please do it soon. Remember that one good idea from a webinar like this more than provides a return on your dues investment. Third is check out the great conversations on CSIA Open Forum, and there have been really good ones lately, and ask your business-related questions too. And I can't imagine you don't have at least one you'd like to ask. And lastly on my bullet list is be sure to participate in the Personnel Safety Program survey that's coming out this week. And the results of all surveys, CSIA surveys, can be found in the survey results library of Connected Community. There's a wealth of knowledge there, so take advantage of that as part of your membership. So as an FYI, all CSIA monthly webinars are archived at our public site, controlsys.org, so you can always refer back to this or any other webinar as time goes by. And finally, this is Bob Lowe, CSIA Executive Director. I want to thank you again for attending. Goodbye.
Thank you, Bob. Thanks, Monica.
So I'm going to go ahead and stop the